Hey everyone, I'm currently recording this from a penthouse in Greece, so excuse me for the setup, but I thought I'd do it now anyways because I think there might be money to be made. So, uh, ISS has once again released their annual report, and I don't know if anyone else has made a video about it since I made mine, so I figured I'll try to do that now. So let's jump right into it. So ISS, as previous year, again, they are a service company, mainly focused on cleaning, but they also do technical and food services. You can also here see their customer segments in percentages and also the geographic presence, where Europe, as you can see, is about 70% in total. Now, I looked at both annual reports and I can see the employees, sites, and customers are roughly the same, which kind of leads us into the 2024 finance performance. So the organic growth was at 6.3%, while last year was at 9.7. Operating margin, they did barely deliver on their outlook they gave last year at 5 points exactly. The free cash flow came in at 2 billion, which is a bit lower than my expectation, honestly, but I mean, it's okay. And their financial leverage is now exactly at 2 times net debt to EBITDA, which we will see has an impact when it comes to capital allocation. Customer retention dropped to 93%, but they claim that was mainly due to deliberate exits of contracts in order to increase operating margin. And they have given outlook for next year. They still expect the same kind of organic growth of 4 to 6%, free cash flow of 2.4 billion, an operating margin again above 5%. Let's see if that improves. And they are expecting about half a point of positive growth through acquisitions and divestments, but they are expecting about 1 point negative effect from foreign exchange rates, which would come mostly from their Turkish branch. About capital allocation, their first point is that they want to have a net debt to EBITDA of 2 to 2.5 times, and now they are right at 2. Dividends, they want to pay 20 to 40% of adjusted net profit as dividends. This year they are proposing 3.1 krona per share, while last year it was 2.4 krona. The third point, they want to do M&A. So they buy mainly bolt-on acquisitions. That means they buy smaller companies that do cleaning and other things that ISS also does, and they sort of bolt them onto the big firm, and they get synergies through, I guess, cutting out the middle managers and things like that. And then as a fourth point, they do share buybacks. Last year, they proposed in February a 1 billion krona buyback. They increased that to 1.5 throughout the year, and they actually bought back around 6% of all common stocks. Now this year they announced buybacks of 2.5 billion kronas, which would be almost 10% of the market cap. Now that is higher than the entire cash flow from 2024. So I guess it concerns me a little bit that they are borrowing money to do share buybacks while also on top of that paying dividends, and I guess probably gonna do some M&A also. So they are borrowing money, but I guess they want to raise themselves from that 2.0x net debt to EBITDA to probably closer in the middle of their wanted range. And now for the valuation. So I created this simple model which would look 5 years into the future, and it expects a growth for 2025 of 5%, and then for 2026 and 2027 4%, and then finally 3% in 2028. And I do trust them on their outlook. I mean, they've beaten it now, I guess, last year, and I think before that too. But this year, I think a large part of it, they said it was because of the hurricanes in the US, which they cleaned up after. And then also their growth has been driven somewhat by the return to office trends. So I would not expect very high growth now, and I would rather be surprised to the upside. But if we take these 2028 numbers now and we assume that we would learn about them in February 2029, which would then the 2028 annual report would be released, and we assume a 5.5% profit operating margin, then we'd have 5.4 billion krona of operating profit, and they aim for a cash conversion of 60% of net operating profit before other items, which would mean a 3.2 billion free cash flow. If we give a free cash flow multiple of 13 times, which is lower than it is today with better fundamentals, then we'd have a market cap of 42 billion. Today's market cap, it had a drop today. It's 27.9 billion. Um, with buybacks of 6% and a dividend of 1.5%. If we calculate that in, it would mean an upside of 94% or a compounded annual growth rate of 14.2%. And now I do like one guy that always tries to double it in 5 years. And if you wanted to double it with these assumptions, you need to buy it at 155, which we are not far from. But I would not be surprised either if they had improved their numbers. So we can do some small modifications to this model, and we can see that very quickly we get a very nice return of 121% total or 17.2% CAGR. And I think it's still conservative. So it really depends how optimistic or pessimistic you are, but I think this is a kind of investment where heads you win, tails you don't lose much, or you even win a lot but not as much. The main risk I would see with this investment is if there's a severe recession and they lose a lot of customers, then it would look really bad that they now are more money to do buybacks. But I mean, that's going to apply to every company. Also, I think you have to consider the fact that the buybacks of 2.5 billion, um, they will buy about 60,000 shares every day, about 65, maybe 70, it depends on the price. But the average volume is about 600,000 shares per day. So I I can't imagine the share price really falling when they are buying back this much. And a big investor of theirs that has been selling a lot has now said that they will stop selling. I mean, this is not investment advice, but you should do your own research because you can't borrow conviction. Anyways, I hope you enjoyed this video. If you did, you can you know put the dislike button. I think that increases engagement more than the like button. And yeah, have a good life.